Welcome to the Contrarian Capitalist podcast. I'm delighted to be joined today by returning guest Doomberg. Doomberg, how are you?
Hey, I'm doing great, my friend. How are you?
Very good, thank you. Plenty to talk about. Last time you were on the Contrarian Capitalist, we've done a whistle-stop tour of energy policy around the world. Ideally, today it would be good to do a bit more of a deep dive into the current situation with regards to oil and natural gas. But my first question, and apologies if this is open-ended, since our last conversation, have we seen any dramatic changes in energy policy worldwide?
I would say yes, especially last week, which is the subject of a piece we published on Sunday and one that we're going to publish again on later this week, which we think has been buried under the avalanche of news around tariffs. Even as we're recording this, I see that Trump has elevated the tariffs on China to 104%, which the market does not seem to be taking rather well. But on Thursday of last week, we saw what we think will be a decision that will be remembered in the years and perhaps even decades ahead by OPEC, where in the middle of the first Trump tariff Wall Street panic, OPEC came out and, as we said in our piece, poured oil onto a burning tape by basically waving the white flag of surrender. In our view, actually, it's not hyperbole to say that OPEC is functionally over. For a very good long time, 50, 60 years, OPEC has done a fairly good job of managing the crude oil markets to maximize their collective revenue at the expense of consumers worldwide. Cartels are illegal in most countries, but we have this giant one operating in the oil market. And
Mhm.
for since the advent of the share revolution, we believe OPEC has been fighting a losing battle. We wrote a piece last year called "How OPEC Will End" or "How OPEC Ends," and it ended, we believe, last week. And the mountain of consequences are just being contemplated by energy analysts, let alone fully digested. We have a whole series of second and third order impacts of last week that we plan to put onto the masthead later this week, some pretty bold predictions. But yeah, I think the earthquake of the year and the one we should spend most of our time talking about is what happened last week, why did it happen, and what does it mean going forward?
Absolutely. Well, you've just done my questions for me, to be honest. So thank you for that. In that case, let's go back to last week and obviously various tariff announcements made, and the whole market. And I think every analyst reacted differently. So it'd be good to get your opinions. Let's just go back then, step by step. What happened? Why has it happened? And then what's the
Yeah.
outlook?
So OPEC has been holding, I assume you mean about oil and not tariffs and generally because, energy is more of our expertise. And so OPEC has been holding off several million barrels a day of supply from the market. And they've been doing this because of a boom in production in the United States. But production in the United States is different than everywhere else in the world, although that's changing, in that the production of crude oil in places like the Permian comes with it a copious amount of natural gas liquids and natural gas itself. And so OPEC is largely a crude oil producing cartel, and the US uh, energy producers are producing the entire mix of hydrocarbons. And classic co-product economics states that when you have one of the things you make be artificially expensive in the market, you're willing to just get rid of the other thing you make for any price at all, or even pay people to take it. And so because OPEC has been artificially holding up the price of crude, that has created a glut in natural gas liquids and natural gas. However, the technology to substitute crude with those byproducts exists, and it requires financial investment only. And when you have huge price differentials that are artificially imposed on the market, people will arbitrage that away. And so what we're seeing is either manipulation of the lighter molecules to directly replace crude in the refinery networks, or switching out the engines to displace crude in the end markets. And basically OPEC caved. So their very existence was the genesis of its collapse, and it no longer functionally exists because they can no longer keep a floor on the price of crude oil like they used to be able to because we are developing substitutes. The U.S. has broken OPEC's back.
Quite an achievement to say the least, if that was part of what they were looking to do. So if they have broken the back of OPEC, and then what's likely to happen next? And I use that question quite freely because I've seen a lot of different reports say different things. There's not enough tier one land, there's structural issues, and I've got some analysts saying, well, these issues don't exist. So again, so the joy of doing a podcast like
Sure.
this is to get your expert
All,
opinion.
all of that is nonsense. So let's start with reality. The U.S. is drowning in hydrocarbons, especially light ones. Um, so much depends on a fundamental axiom, which is as follows. Natural gas in the US will be used as the bridging fuel to power data centers to meet the ever growing demands of artificial intelligence. Um, I believe that to be true. Natural gas is very valuable. It's clean burning. It's reliable. If you have your own turbine, you could create, a AI pod where natural gas goes in and data comes out the other side. And I believe that's the future. In that world, where natural gas becomes more valuable, well, something really profound happens. If it becomes more valuable than oil, which it could, something very profound happens. So bear with me. In order to view the energy landscape today, you have to understand that there are three types of oil and gas producers. There are people who only produce natural gas. There are people who only produce oil. And then there's a third category now, which is new, which is people that co-produce them from the same wells. It is the emergence and growth of that last category that has so disrupted the energy markets. Now, this is places like the Permian, you know, um, other large shales in the U.S. Concurrent with that development, there's a huge boom in shale gas from places like Appalachia and Haynesville, which doesn't come with oil. So they're in the we produce only natural gas category. OPEC is in the we only produce crude oil category, although that's changing. I'm being general here for effect. And then in the middle, you have the new people who are bringing both gas and oil to the market, and they don't really care which byproduct captures the highest price as long as one of them does. So in a world where natural gas suddenly is very valuable because it's clean burning, it's abundant, um, we can power our data centers with it. If natural gas is $5, $6, $7 a million BTU in the US, well, all of a sudden in the Permian, oil becomes the nuisance byproduct that you dump onto the market at any price because you want to drill for natural gas. And in that world, all manner of fundamental assumptions are going to be scrambled. So who wins in that world? Obviously, the dry gas producers win, as long as they have the discipline to not overreact to newfound demand and to operate with some discipline. And they have a spotty track record at best at doing that, but at least in the short term, they would win. The oil-only producers are going to get crushed, which is why you see offshore oil drillers and their stocks and the associated supply chains that serve them getting crushed since the OPEC announcement. If gas spikes, then the co-producers will be just fine because they're agnostic to which side of what they're bringing to the Earth's surface, which side of those two, or three molecules pays. It doesn't matter to them as long as the sum of what they're selling is above their cost of capital. And so you're going to see a world of hurt for crude oil only producers and producing nations. I think if gas in the Permian, which by the way is still a glut today, this is a longer call than like next week. But as a trend that you want to bet on, that you want to think about, that you want to observe, and I have some market milestones and markers for people to look at to see whether we're right or not. But if natural gas got to $5 or $6 a million BTU in the Permian today, up from negative most of last year, I think oil's $25 bid. And I don't think it's on anybody's radar. Inelasticity is a powerful force that works in both directions, as we saw during the COVID pandemic when oil went negative, right? Um, if natural gas becomes the most valuable hydrocarbon on the board, then crude oil producers who don't produce natural gas are in the hurt locker. And counterintuitively, it also hurts LNG producers. Why? Well, right now in Europe today, Brent crude and landed LNG are trading at energy parity because there's enough overlap, enough substitution ability between the two fuels that they tend to keep each other in line. They're both burned to create heat. Heat is heat. In a world where natural gas is expensive, that makes LNG more expensive. And if LNG is more expensive than Brent, because Brent's going to be in the toilet, people will switch to oil. And so, counterintuitively, high prices of natural gas in the US also hurts LNG exporters, sorry. It makes LNG relatively cheap, relatively more expensive compared to Brent, right? And so you get what I'm trying to say. Like there's all these second and third order impacts of this, and so we think it's coming. Like the U.S. is going to win the AI race or try their darndest to do so. Last point, it's bullish coal. China's going to burn as much coal as they can, and if natural gas is expensive in the U.S., Trump's already laying the groundwork to save old coal plants and to revitalize the coal industry through executive order. Coal gets a bit of a rebirth here. I note with some interest that Newcastle Coal and Henry Hub natural gas are trading for energy parity as well. And so, if natural gas goes up, coal becomes a deal. And they're both burned to make electricity in the US in large quantities still. So lots of moving parts. Hopefully that sort of gives you an insight into what we're writing about. We're publishing this in detail probably on Thursday of this week as a follow-up to a piece that we just put out on Sunday.
A lot to unpack there and a lot of moving pieces. And I think what I imagine quite a few people will look at, and we all do it, is look at the generic headlines and let's go back to Trump and tariffs. They will look at what's going on, trade wars, etc. And we've seen quite a decent sell-off. I use that term lightly. So Brent's down what 10-15%, call it, for example. And then you will see people that say, well, hang on a minute, this isn't good. This is potentially recessionary. Oil's going to go down much further. Um, and what what I understand is that if that happens, and let's just say Brent continues to slide down, then actually that could create advantages on the natural gas side and even on the coal side. Just so I've got that clear, is that the does that
Well,
sound about right?
if Brent goes down, it puts pressure on LNG prices.
Mhm.
And if you have lower LNG prices because Brent is cheap and you have higher natural gas prices where you're freezing this stuff, you're squeezed in the middle as an LNG producer. Don't forget, natural gas starts in a pipeline somewhere, gets sent to a liquefaction facility, gets chilled into a liquid and put on a boat and sent to Europe where you pay the landed price, which pays everybody's cost of capital in the supply chain. So today, landed LNG in Europe is 11, $12, right? Per million BTU.
Mhm.
Multiply that by 6, you get the price of oil. $66, 11 times 66. 11 times 6 is 66, sorry. So Brent and landed LNG are trading at an energy equivalency price. If Brent is much cheaper, you'd switch back to Brent, and that reduces the demand for LNG. But if natural gas to feed your LNG export facility in the US has doubled from here, instead of 390, it's $8. There's no margin, there's no spread for the LNG producers. That's why I think they get squeezed in our base case scenario. All of this is predicated on natural gas being used to feed AI data centers in the US and Western Canada, which we think is coming. And so we're trying to think 6 to 18 months ahead to give people a broad trend of where we think things are going.
Is there anything that you could, and again, appreciate you got an article coming out later on this week, so try not to do that article a disservice in any way. Is there anything else you can add in terms of generic fundamentals or predictions uh, to this podcast? Is there anything you can add to the podcast, or is it just a case of waiting for that article to come out, just
Oh
to
no,
give people a rough idea of
I'm
what to expect?
happy to talk through the whole article.
Okay.
Because, it's a good advertisement for our newsletter and the type of thinking that we do. And we publish 90 of them a year. So if I spoil one for some of the people who read it, that's not a big deal. Um, in the long run, all hydrocarbons will sell for the same price, corrected for energy content and logistics. That's sort of the mother of all arbitrage forces that is at the center of our analysis of the energy markets internally. And when we see large deviations from that, we see opportunity. What is the source of that dislocation? Who will profit from closing it? When will it get closed? So I'll give you an example of the type of metric that we follow very closely internally. It is the ratio of the price of oil, Brent or WTI, divided by the price of natural gas at your favorite location. So I already told you that ratio is basically 1 Brent divided by LNG, right? Sorry, it's six. It's energy parity. It's 6. Um, that is energy parity. So there's 5.8 million BTUs in a barrel of oil. Natural gas is priced at dollars per million BTU. You multiply the natural gas price by 5.8, or you divide oil by 5.8, you get the LNG price. And so at one point last year in a piece we wrote called Generational Arbitrage, the ratio of the price of oil divided by natural gas was in the mid 50s. Remember, 6 is the equilibrium. And we came out with a piece saying that this had to close, and it has. It's down to 16 today. If that number gets down to 6, WTI divided by Henry Hub, for example, if that gets down to 6, then the scenario we just outlined, where natural gas is the valuable molecule and oil is given away, has arrived. And so we will follow the ratio of WTI divided by Henry Hub every day. It's on our Bloomberg launchpad. The other thing we follow is spot prices in the Permian Basin, because that's where most of the gas is. That's where we think a lot of AI is going to co-locate with the gas. And that's where the co-production of oil also happens. And if gas goes up in price in the Permian, that's very bearish for oil in our view. And so those are the types of milestones that we watch, that those ratios. And if you know how the markets move over time, then you could see that the trend is working. And in fact, in the piece on Thursday, you'll see that oil to gas chart. And when we first published Generational Arbitrage last April, we followed it up with a piece called Bridge Burning. In October, the ratio had gone down to like 25. Now it's down to 16 as we're recording this. We think it's on the way to 6, if we're right. And if we're right, all of the other consequences that we just discussed will materialize. So, but the long-term trend, like there's no reason why natural gas should be cheaper than oil. It's cleaner burning. Yes, it's slightly more difficult to handle, but with every new pipeline built or LNG import or export facility that comes online, that logistics gap closes. And so the equilibrium price of natural gas should be, I don't know, 10, right? It shouldn't be, because you have to add some logistics. It's easier to move a liquid around. But when you correct for energy and logistics, all hydrocarbons around the world will trade for the same price eventually. And that is like a giant mega trend that investors can bet on.
In terms of, I'm trying to refer back to a piece, and I'll be honest with you, I forgot the name of the exact piece, so my apologies for that. I was reading the piece that you'd written a little while ago, and you were looking at the storage levels, I think, in the EU.
Yeah.
And it was to do with the fact that if there's still issues between, for example, the EU and Russia, which let's be honest, that they're probably going to go on for a little while, whether we like it or not. And looking at the storage levels in the EU, they were, I believe, lower than normal. Is that correct? And if so, what impact could that possibly have moving forward?
Yeah. Great question. The piece was called Dead of Winter from memory, and I think we published it in mid-March. So OPEC's move last week, in a way, gives relief to Europe and takes some pressure off of that crisis that we were flagging. If LNG is cheaper, because there's less demand for it, you could switch to cheaper Brent, and also for all the other reasons we talked about, um, then Europe wins. Well, it doesn't win. It doesn't lose as badly as it was trending towards. But cheap energy is good for everybody, by the way, except for the energy producers. Um, and so, all things being equal, OPEC's move last Thursday gives breathing room to Europe that didn't exist before Thursday. And of course, if we had known that OPEC was going to capitulate, you know, 3 weeks after we wrote that piece, we probably would have had a slightly different conclusion.
So just trying to think out loud here. So the OPEC move there has put Europe in a slightly better position. So I mean, they're probably going to still end up losing, you imagine, because of you know bigger generic policies. But it probably helps them potentially in the short to medium term, if even if there is a broader market sell-off, which will then further impact Brent prices, it still puts Europe in a it still puts them in a losing position, but not as bad as it could have been before OPEC announced what they did.
When you're structurally short energy, as Europe is, you want gluts of energy supply, like as a very broad general rule, right? It makes sense. When you don't have it yourself to make, um, then you want the world to be flush in it. And look, since OPEC made that announcement, landed LNG in Europe is down 15%. That's good for Europe. That means they can refill their coffers for less money that they have to print. And so, again, all things being equal, and all things aren't always equal, but if you try to isolate the impact of OPEC's decision across one dimension, it was a positive day for Europe.
Perfectly understandable. Thanks for clarifying that. Going back to the US, I know that yourselves have been very big advocates for Chris Wright, the Energy Secretary. Uh, how I know there's a lot been going on in the last couple of months, but how do you think everything's gone so far? And just for people that are not familiar with Chris Wright, why are you such big advocates of him in his position?
Right. So um, there's an interesting situation developing with regard to that question that we have been flagging for a while, which is we tried to warn our friends in the energy industry that our guess is like 95% of them voted for Trump. Trump wants cheap energy. You make your money when energy prices are high. You're not going to make money under Trump. And we like to say internally that the energy sector builds during Republican administrations and makes all their money during Democratic administrations because the supply discipline is imposed on them by the government during those years, and they make money when prices go up. So Chris Wright, for those that don't know, is a entrepreneur, brilliant person who founded a couple of unicorns, most recently Liberty Energy. He was the founder and CEO of that company and the brains and the brawn behind it, and understands energy better than any Secretary of Energy in the history of the United States, and is committed to implementing Trump's agenda. He is pro-energy abundance, which ironically is counterintuitive to the fiduciary of his company that he no longer runs. But Trump wants $50 oil. He's going to get it, which I've been flagging. We have been flagging as a blog for many, many months. 95% of the people that voted for Trump are voting against their equity. It's not in the interests of E&P stocks that Trump is president. Trump wants cheap oil for the rest of the economy to boom. And in return, they'll probably give them long-term leases to lucrative federal lands, and maybe they'll term out the refilling of the Strategic Petroleum Reserve, and they'll get other kinds of goodies. And in fact, the super majors like Exxon and Chevron love this. They have the balance sheets to weather the storm, and they buy everybody up on the cheap, and then wait for a Democratic administration, and they print cash. And so there's all kinds of, the small producers aren't very happy right now. The big producers don't mind. There's undercurrents. And so when you're at, the large industry conference, and Chris Wright is the keynote speaker, and you're hearing Javier Blas from Bloomberg read a fascinating article about the mumblings in the crowd about how they were upset with Chris Wright because they thought he was our guy, and in fact, he's Trump's guy. I mean, this was flagged for a very long time. Trump wants energy dominance doesn't mean prices go up. Energy dominance means we flood the world with supply because the U.S. can, and that newfound cheap energy source is the literal fuel that powers the U.S. industrial revolution. Which again, Trump has been very, very clear, very straightforward with what he wants to do. None of this should be a surprise. I'm surprised at how often the market is surprised. He's literally doing everything that he said he was going to do, including on tariffs. You can go just Google if you're listening, get on your Google machine and put in Agenda 47 videos, tariffs, and watch the 5-minute video that Trump published in February of 2023 and find one word of deviation from what he said he was going to do. It doesn't exist. He is literally doing precisely what he said he would do, what he campaigned on, what he repeated ad nauseum at rally after rally after rally. Whatever you think of the man, he has energy. And he has followed through with precision on exactly what he said he was going to do. And so if you just trade Trump's behavior, all you have to do is listen to the man. It's the easiest trade in the world.
Which is fascinating for a politician because I think people are so ingrained with what they say being different from what they do and vice versa that I think we touched on this actually last time you were on, that if Trump were to get in, that these things could happen because he is literally wants he's learned a lot from last time, but also he's been very clear with this is going to happen and then actually acting it out as he has done. He's almost like a breath of fresh air, to be honest. So
Sure,
yeah, I get your point.
like him or hate him. Look, the man nearly got killed.
Mhm.
Whatever you think happened that day doesn't matter. What matters is what Trump thinks happened that day, because he's the president. I'm a guest on a podcast, you're a host, and everyone else is listening. We're all irrelevant compared to Trump. So the core issue is to understand what's going through his mind. He thinks God saved him to implement the plan that he put forward. Now, you might think that's crazy. You might be an agnostic. You might think that Trump is a narcissist to the extreme, all of those things. He is probably all of those things. He's a very complex man. Um, but he's a maximum I don't give a you know what phase right now, which is why he's rolling out 104% tariffs on China, right? Today, April 8th. We'll see how long they last. That is the functional equivalent of shutting the US borders. This is COVID style lockdown without the PPP plans in place. He is going for broke. Come hell or high water, Trump is going to fix what he believes is a fundamental flaw in the way in which global trade works. Again, you could think he is naive or that he's wrong. He's going to do it. Play the pieces on the board as they lie. He is going to do it. I don't think he's going to back down. Who knows what happens? Maybe this tariff on China leads to a hot war because Xi says now's the time to go for Taiwan. Like we are entering chaotic times in the scientific meaning of the word, sensitive dependence on initial conditions. Um, who knows what happens from here, but you do know what Trump is going to do. He's going to do what he said he did. So if everybody listening would go spend 3 hours watching all of the Agenda 47 videos from start to finish, nothing in the past 3 months will come as a surprise to you. Nothing. He's, whatever the subject, he's doing it. So it's there. Everybody can see it. The market is mispricing it.
As I like to say, it's pretty much from a generic market point of view. It is likely to be a case of in this case 2 steps back and then multiple more steps forward. And it follows on to what you said. He's doing exactly what he said he would do, and it's
He
it's been
doesn't
quite
care.
easy to read.
He came an inch
Mhm.
from being killed on live television.
Mhm.
By the way, why was CNN covering that one live? I'm sure he's asked himself that question. Um, so he literally believes he's on a mission from God. Now that's historically quite dangerous. I'm the first to say it. It's quite dangerous. Um, but it is what it is. We have to play the pieces on the board. Our job we view our job, what we believe our subscribers pay us to do, is to analyze reality and reflect it back to them to the best of our abilities.
Keeping in keeping in with the theme then of reality, is I think as we've covered. So we've got oil at the well, more than likely going to be going down to 50, given everything that we've just discussed. We have a small win for Europe, even though they've got to take what they can at the moment. Last time we had a chat last year, we looked at energy policy around the world. I see that there's been some more. Well, certainly in the UK, they seem to be continuing to shoot themselves in the foot. What else have you seen from around the world that's possibly energy-wise that's changed since last time we spoke?
The most significant thing besides OPEC last week that has changed since last time we spoke is the complete severing of pipeline gas connections between Russia and Europe, except for two large pipelines that go through Turkey and get redistributed via Turkey, Turkstream and Bluestream. All other natural gas that used to flow from Russia to Europe has ceased, most recently through Ukraine. And that is one of the reasons why we wrote Dead of Winter, because as Europe goes to refill its gas into the summer months, it no longer has one of the arteries pushing blood into the continent. Um, and it's a big artery, which means it's going to have to rely even more on LNG, which is why OPEC's move is not a small relief for Europe, but potentially a significant one. Um, that's the biggest change on the board. Um, Beyond that, we still see China stockpiling coal at huge rates, building out hydroelectric dams, building out nuclear power. Um, those are the sort of the big ones. And then, of course, very bearish renewables. Tariffs are bearish for solar in particular because of the over-reliance on China. So no solar project that has not yet received its panels is going to get built in the US as long as this tariff war is going on. And then Trump has just taken a kneecap to the offshore wind industry in particular. So, I mean, the amount of change that has come just since January 20th is truly remarkable. It's dizzying. And I would say, you know, between us, it's kind of hard to write a newsletter on a 4-day cycle with Trump in office because we suffer from what we would call significant headline risk. You research, write, edit, and get ready to publish a piece, and then the whole world changes because of one Truth Social post, which makes
Mm.
operating our particular business somewhat challenging. At the same time, very interesting because there's certainly no shortage of things to write about.
Yeah, it's been, I think, as we said off air before recording, that's why it's quite clear that, all being well, this will go out today purely because I appreciate, as you said, it could be one tweet, it could be. I was watching the markets yesterday, and there was I use the term loosely, news leak about a 90-day pause on tariffs. And Wall Street, or the Dow Jones index, went up by 2,000 points in the space of about 4 minutes. And just looking at that, and it turned out that headline was fake. It's just, yeah, I think it's crazy times at the moment across the board. So I completely understand your sentiment there, Doomberg.
Yeah, and I will say about that headline, I wouldn't dismiss it because it also is part of a trend that we've not written about yet, but there is no SEC anymore. Um, and it's a free for all, wild, wild west in the equity markets, in the capital markets in general. It's going to be a lot of fraud. Um, you see companies leaving Delaware. There's all manner of sort of erosion of U.S. capital markets and their integrity that is a underreported story of the Trump administration that I think will only grow worse over time. And I do believe, personal opinion, that that headline was planted by somebody who benefited from it greatly. I saw somewhere that it was the biggest intraday move percentage-wise in 15 years, all on a fake headline. It was such a whiplash of a headline that you saw the whiplash in the stocks. And I would not be shocked if you traced down the electronic trail of how that whole situation originated. You might find some people who were um, pretty low on the market heading into that. But that's just my hunch, and the fact that, in the olden days, people were so afraid of the SEC. Now, who's afraid of the SEC? I mean, um, it used to be that a Wells notice was the end of your career, and now you just, smoke them out, wait them out, and new administration lets you off the hook. It's not good. The whole concept of preemptive pardons, by the way, is a whole other challenge to American institutions. And so we're not, as much as, the headlines of tariffs and OPEC collapsing and these things sort of catch you in the 24-hour news cycle. I think like the 6 to 18-month news cycle is the degradation of the SEC. The SEC is a paper tiger compared to what it used to be. And frankly, U.S. capital markets were better when it was feared than it is now.
Yeah, perfectly understandable. Again, it's something else I agree with. This chaotic times, very interesting times to say the least. Just to recap everything, so we've looked at obviously the OPEC decision from last week. We've looked at natural gas, looked at Brent in general, looked at gas pipelines over there in Europe, what Trump is doing, etc., etc. Is it ever any other energy news stories, anything that we haven't spoken about yet that you think people need to be aware of? Whether that's a short term or long term trend is fine. Anything we haven't spoken about that you think people need to know about before we finish up?
So on the one hand, I think that's plenty. But on the other, there's an enormous amount going on around the world that doesn't get enough attention. I think we're seeing a renaissance in Argentina, really major shale development outside of the U.S. One of the sort of the first big ones, the Vaca Muerta shale. Um, Obviously, Guyana and the potential for regime change in Venezuela could really change things. I think Trump is actively going for that. I disapprove of such things, for the record. Back to just trying to analyze the pieces on the board. I think um, should Venezuela fall into the fold of U.S. geopolitical influence, that's a game changer. I think for whatever reason, Trump wants Mark Carney elected in Canada. We made that call in December, one of the best calls we've made. And it looks like Carney it might win the election for whatever reason. Trump seems to prefer him and has done his level best to get Carney into position. Um, and we're working on a piece we haven't published yet where we think Alberta is going to collaborate with Carney to leverage a fake separatist threat in order to get the infrastructure Canada needs to unlock its energy potential, while at the same time giving Mark Carney a face-saving way to walk back the carbon nonsense that he's been spewing for 15 years as a globalist delight. And so we tend to look at the news in lateral ways, ways that people don't necessarily think, that certainly the headlines don't tell you. And sometimes we're wrong, but we have a pretty good track record. And so this is what our subscribers pay us to do. So plenty of fascinating things in the energy space to write about and then talk about on shows like this. But I figured I'd at least give you a taste of the things that we've been thinking about internally.
Oh, I really appreciate that. It's always good to get an in-depth view or go behind the scenes, so to speak. So thank you for doing that. Doomberg, I appreciate I've done this last time, but I always like to give people the opportunity to explain how you can be found. Obviously, a fantastic Substack that you have as well. But again, for people that are not necessarily familiar with yourselves and the work that you do, how can people find you?
Sure, you could find all of our work at doomberg.com. And we have two product offerings. For $300 a year, we offer somewhere between 7 to 9 articles a month on topics like what we've discussed today. And then we also have a premium service that, in addition to those articles, gets a monthly deep dive presentation that we put together. Usually runs between 45 minutes to an hour, where we'll take a topic like, China through the lens of energy and do a 50 or 60 slide presentation on it, giving our premium subscribers, we call it our pro tier, and those presentations are known as Doom Zooms. Um, and they come out once a month as well. And that's directed towards the institutional/wealthier investors who can afford to pay for premium access to that kind of thinking. We tend to follow up those presentations with articles in the month afterwards, and so we sort of reuse that research into our pieces as well. And if you subscribe, you get the full collection of 365 articles we've written now, which is crazy. And also, if you're subscribed to our pro tier, I think we're up to 40 such presentations in the archives as well. And you could go back and see our hit rate and what we got right and what we got wrong and why. And the last thing I'll say is our subscribers know that no matter what, the moment we press send, we 100% believe what we've written in that moment. Things may change, data comes in, we're the first to admit it, but we believe what we write in the moment we press send, and we believe that authentically expressing what we believe to be the truth is the core ambition of our brand. So with that, really appreciate the opportunity. I always enjoy our conversations and looking forward to coming back soon.
Doomberg, fantastic. Thank you very much. And for those listening on podcast format or even on YouTube watching this, all those links will be in the descriptions and the notes that come with this episode. Doomberg, fantastic as usual. Look forward to round 3 later on in 2025.
You bet.